What's up everybody, welcome back to my YouTube channel. My name is Javi, and in this video I want to dive into why the stock market has continued to sell off in the last 2 weeks, as well as what I think is going to be happening in the market in the short term, and what I think that we should do as retail investors to maximize this opportunity. If you have not seen my last video, please make sure to watch that one. In that video I talk about why the stock market first started selling off, as well as what I think that we should do. So if you guys get any value out of this video, please make sure to click that like button and make sure to subscribe for more videos coming up. Okay, so since February 19th, we've been seeing that the stock market has been selling off pretty consistently every day, and there's been a big rotation from tech into value plays. Now, I personally don't think that this is the best thing to do as an investor, moving your money into tech, from tech into value, because a lot of these value or recovery stocks are not doing so well. And even if the economy opens up in the near future, these companies are still suffering a lot, and they are not going to be doing that great in the long term. So I don't think that moving your money from tech into value is the right play to do, even if you see that there are some short-term rewards from putting your money into value. So why has the market been crashing? So I kind of touched base on this in the last video, and I talked about yield. So bonds have been going down and leading yields to go up, and as yields go up, the stock market has been going down. Now, the reason why yields are going up and stock markets going down is because of the rate at which these yields are going up. So yields have been going up very quickly and have been touching rates that usually are not seen in the stock market. And I touched based on that in that video. So the reason why yields are going up are for two reasons. First, it's because of fear with the economy growth. So with this pandemic, there's a lot of fear that the economy may not be growing at the same rate that it would have been growing back before the pandemic. And there's a lot of investors out there pricing in that the economy is going to be growing at the same rate, if not better. So the stock market is kind of pushing back and saying, okay, maybe the economy is not going to grow at the rate when everything opens back up. So that's the first reason. The second reason is, with this new stimulus check going out, these bonds need to be sold so that the stimulus check can be given out to people. So to make this more enticing for investors, yields have been going up so that people can go and put their money into bonds to be able to pay out these stimulus checks. Alright, so aside from yields, the second reason why the market is crashing is because of fear of inflation. So a lot of investors are very fearful right now because they think that inflation is going to be occurring in the near future, and with a reason. With all the stimulus checks that have been given out, there's more money in the market, or more money in the economy. And once the economy opens up and people start doing whatever they can, then there's a fear that all this new printed money is going to be spent, and that's going to lead to inflation. Now, there's a few reasons why I don't think that this is going to actually happen. Well, the first reason is Jerome Powell himself is not going to cause inflation because he wants to make sure that employment rate is maximized. And usually in recessions, there's a small group of people that are usually left behind, and that is usually blacks, Hispanics, and women. So he wants to make sure that these group of people are at its minimum before he starts taking any action. So from his point of view, we're not going to be seeing inflation anytime soon. Another reason is that the velocity of money, which is how many times people are purchasing something and the money is being circulated within the economy, has been really stable and low lately. So with all this new money printed, that may just show that people are not actually going out and spending money, but they're actually saving money. So as a result, we're not going to be getting inflation because money is not actually going and circling around at the rate that it usually was circling around. Now, lastly, I think that as tech and innovation get better and better and things become more efficient, then as a result, inflation is not going to occur. Because if someone can do the same thing a lot cheaper than they were able to do a few years ago, then there is no reason to increase prices, because your margin is still better than it was a few years ago. So tech and innovation is going to minimize inflation occurring. And that's why I think that investing in recovery plays right now is not the thing that us retail investors should do. With tech getting hit really hard right now and everyone moving from tech to value stocks, I think right now as an investor, it's time to put your money into innovation, tech, and genomics. And now, this may not be the play that is going to rise in the short term, but in the long term, this is going to be very, very beneficial. Okay, so tying everything back together, the stock market has been selling off because of yields going up and because of fear in the market due to inflation. I personally do not think that inflation is going to be happening anytime soon. Now, will inflation happen? Maybe there's going to be a small amount, but not at the rate that someone should be fearful. And then this rotation from tech into value is actually a very good opportunity for us retail investors to park our money into tech before the price goes up. Now, as a retail investor, we don't move the market, but when the big fish go and see that tech is actually very affordable at the moment, then they're going to move their money out of value back into tech. And at that point, that's when tech is going to be moving up at such a quick rate that you may have lost that opportunity. So it's better right now to buy this dip, buy this opportunity, not look at the stock market. Okay, and just to show you guys that I'm doing what I said I'm doing, I have my computer here and I just want to show you guys, tell you guys the stocks that I'm investing in. So since February 19th that this dip has occurred, I've been putting a lot of money into Tesla. So February 22nd, I put $1,500. February 22nd again, I put $740. On February 26th, I put $466. March 4th, I put $635. March 8th, I put $590, and then finally on March 8th, I put $1,174. Now, you don't have to put all your money into Tesla. That's just personally what I'm doing, but I think that Tesla right now has been hit really hard for no reason of their own, and they are going to be recovering at a better rate than a lot of these other tech and innovation companies. Now, if you want to diversify yourself just a little bit more within this tech and innovation and genomics, then I do think that you should do some research and invest in what you feel comfortable with. Okay, so for a lot of you investors who want a timeline on how long I think that this drop is going to occur, I think personally that this is more of a correction. So this is probably going to last more between 4 to 6 weeks, and we did see that this started back in February 19th, so it's probably going to be roughly until the end of March before we start seeing some upside in the market. I do not think that this is anywhere close to the .com era, where that market dropped very hard and it took a lot of years for stocks to recover back to what they were previous all-time highs, and I do not think that this is a 2008 market crash. So in that regard, I think that a lot of investors can kind of sit back and not stress so hard on that. Now, I did say that this is a correction that can last anywhere between 4 to 6 weeks, but there is one thing that I think can potentially make that go quicker, and that is the stimulus check. So from the day of recording this video, the stimulus check has been passed, and I think that this may actually help out the market. The reason for that is with the stimulus check going to people, and when I mentioned earlier that people are not spending their money as much as they used to, well, with this artificial money that is being printed and sent out to people, a lot of people will probably choose to save and invest this money rather than go out and invest it and spend it, Now, there are people who will need this money, so obviously they're going to pay bills and do what they need to, but even after that, they may have some money that is left over, and with that money, they may go and invest it. So if everyone is taking that money and investing, or even some people are taking that money and investing it back into the market, then as an investor, you are going to see a higher return than if this money was not printed. So I think that is going to be potentially a stop to this correction, and I personally believe that the market has not accounted for the positive side of the stimulus check. It's only really been accounting for all the negative stuff that can happen due to the stimulus check, as well as the potential slowness of the economy due to the pandemic and all the money that's been printed. But if the economy actually grows at the rate that it was growing before, and all this money that's been printed goes back into the stock market, and the velocity of money actually stays at a rate that is right now, we might be pricing in worst case scenario, but in reality we may actually get a really good case scenario, and the market may actually bounce back and go way past what it is right now. So that's why I think that investing your money into tech is actually a really good decision. Alright, so that wraps up this video. I hope you guys get some value out of it, and if you guys are out there and are stressed out with this market sell-off, I just want to tell you guys to just hold on. We're getting near the end of this. I do not think that this is going to be lasting a lot longer, and there is a lot of upside to be made. So if I were you and you're stressed out, I would maybe just delete the app, or maybe not look at the market and try to stay away from it as much as you possibly can. And if you have some money aside, or if you have some money that's coming in the next few days and you can afford to invest it back into those 3 things that I mentioned earlier, then I would do that if I were you. With that said, if you guys like this video, please make sure to click that like button and subscribe for more videos coming up. If you guys have something particular that you want me to talk about, then please make sure to leave that in the comment. And with that said, I will see you guys next time. Peace.